The Kansas City Approach to Modern Money Theory by L. Randall Wray. Section 2. Credit Money, the Monetary Circuit and Endogenous Money. Over the course of the 1980s, post-Keynesians embraced an endogenous money approach. Basil Moore developed what he termed horizontalism, which viewed both the supply of money as well as the supply of reserves as horizontal at an exogenously set interest rate. This was contrasted with the monetarist, verticalist approach that saw the money supply as exogenous, set by the central bank, and the interest rate as endogenously determined by the market. Mark Lavoie, 1985, helped to revive a circuit approach to money that was based on earlier work by French economists. This became the Franco-Italian circuitist approach. Its view of banking recalled the real bills doctrine. Money is created to finance the production process, and was consistent with the monetary theory of production. Production begins with money to produce commodities to sell for more money. Adopted by the three great fathers of the various strands of heterodoxy, Marx, Veblen, and Keynes. Both of these approaches rejected the textbook deposit multiplier story, insisting that money is created ex nihilo, out of thin air. Central banks provide reserves used by banks for clearing purposes, and in the horizontalist story, they must always accommodate the demand to hit their overnight interest rate target. In both approaches, the government's role is downplayed. Augusto Graziani, perhaps the leading proponent of the circuit approach, insisted that government is like any other user of money and subject to the same rules. It has no seigniorage rights and cannot settle its debts using its own liabilities. Graziani, 2003. Most expositions of the circuit approach do not even include a government. The government is similarly excluded from horizontalist discussions, and the central bank's role is generally limited to setting the overnight interest rate target and fully accommodating bank demand for reserves. Horizontalists have been among the most vehement heterodox critics of MMT. However, as mentioned above, Moore participated in the earliest discussions with Mosler on post-Keynesian thought, and was among the first to understand Mosler's claim that government bond sales are a reserve drain, not a borrowing operation. In my 1990 book, I explored the history of the endogenous money approach from the banking school, currency school debates, 1830s to 40s, through Marx, Keynes, and Schumpeter. I argued that while endogenous money views were common or even dominant until Keynes's general theory, both the Keynesians and the monetarists of the post-war period adopted the exogenous money and deposit multiplier approaches. A revival of endogenous money can be traced from Nicholas Kaldor and the Radcliffe Committee, 1959. The work of John Gurley and Edward Shaw in the late 1950s, James Tobin, 1963, and Minsky from the late 1950s. Moore and other horizontalists interpret Keynes's treatment of money in the general theory as exogenous, fixed by the central bank, and claim that his liquidity preference theory is inconsistent with endogenous money. In my 1990 book, and elsewhere, I integrated Keynes's liquidity preference theory from Chapter 17 of the General Theory with his endogenous money approach, which was clear in the treatise. I argued that while Chapters 13 and 15 can be interpreted along the lines that led to the orthodox ISLM analysis with an exogenous money supply, Keynes's Chapter 17 approach to asset pricing provides the rigorous exposition of his liquidity preference theory, and this is perfectly consistent with endogenous money. Footnote 12. I will not go into a discussion here, but Keynes seems to have made strategic errors in his exposition 3 times in the general theory, all of which adopted a supply and demand approach. In his discussion of the labor market, where he accepts the neoclassical labor demand curve with the wage equaling the marginal product of labor, when he characterizes the investment decision as one that compares the marginal efficiency of investment against the market interest rate, and where he adopts a money supply and money demand determination of the market interest rate. All of these have led to problems in interpreting Keynes's argument. The first two are subjects of the two Cambridge controversies, and the third is subject to the horizontalist critique. See also Wray, 1992. End footnote. In my dissertation and the 1990 book, I provided a close institutional analysis of the practices of modern banking. I included discussion of the rise of non-bank banking, what later came to be called shadow banking, and of the increasing use of off-balance sheet operations by banks. I showed that direct lending by banks had already declined to just 18% of the increase in debt issued by non-financial corporations by 1986. I warned of the new trend toward securitization and use of derivatives that might appear to allow banks to hedge risks, but that interdependence of on-balance sheet and off-balance sheet commitments, or covariance of shocks, can lead to the transmission of shocks throughout the system. Wray, 1990. I argued that credit risk was actually becoming more concentrated among fewer behemoth institutions, and that this would come back to haunt the Fed, as it would eventually have to act as lender of last resort to cover even the off-balance sheet items. That is precisely what happened in the global financial crisis that began almost 2 decades later, in 2007. In all of this, I followed Minsky's view that, quote, anyone can create money. The problem is to get it accepted, end quote. In the 1990 book, I used Minsky's notation of a pyramid of liabilities, with the most acceptable government liabilities at the top, then chartered bank liabilities, non-bank bank liabilities, non-financial corporate obligations, and finally the debts of small firms and households at the bottom. This pyramid reflects acceptability and liquidity, which entities lower in the pyramid using liabilities higher in the period for payments. Minsky's understanding of money and banking was much deeper than that of the developers and followers of the horizontalist or circuitist approaches, which focused on an outdated real bills view of commercial banks. Minsky was among the first to fully recognize the importance of securitization, arguing in 1987, quote, that which can be securitized will be securitized, end quote. Minsky and Wray, 2008. He went on to analyze the tremendous changes to the financial system that followed innovations of the 1980s in a series of papers and conferences at the Levy Institute in the early 1990s. His research program at Levy tackled reform to, quote, reconstitute the financial system to promote the capital development of the economy, end quote, that continued after his death. I warned of the financial speculation that would lead to collapse beginning as early as 1998 and up to the global financial crisis of 2007. Footnote 13. For an early warning, see Wray 1998b and Godley and Wray 1999. For one of the earliest analyses of the subprime mortgage crisis, see Wray 2007, which uses Hyman P. Minsky's approach to analyze the current international financial crisis, which was initiated by problems in the American real estate market. And for an analysis of the commodities market bubble, see Wray 2008, which uses Minsky's money manager capitalism approach. End footnote. Some critics have wrongly tried to claim that MMT leaves out the private financial system. Nothing could be farther from the truth. The Kansas City levy proponents of MMT have been in the forefront of the analysis of the evolution of the financial system, standing on the shoulders of Minsky.